Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. As always, these videos are just for informational purposes only and educational purposes. They are not investing advice. So, we're going to do something a little bit differently than we've done the past couple videos because we're dealing with a deep cyclical stock in this video, and I haven't covered one of those for a while on the YouTube channel. Not since we were back, I don't think, I'm going from memory, but when we were buying refiners like Valero and things like that. So the approach is different. I recently published an article that says I'm lowering my buy price for US Bancorp. And it was a pretty short article and kind of to the point article. But I didn't really get into like the specifics of the strategy itself that led to the original buy price. So I'm actually going to do that in this video a little bit more. So I'm going to rotate between an article that I published last summer where I went through the whole process, and then I'll also come to this latest article where I decided to lower my buy price for USB a little bit. So I started this article by reviewing kind of the history, which is usually what I do in articles, because I don't usually tell people like a big long story about the business or anything and how great it's or bad it's going to be. Either one. I usually, if I've written about it before, I just show how my ideas performed. So I bought USB during the March 2020. Actually, it was a little after the March 2020 crash. It was in May. It kind of took a double dip, and I still had a lot of cash left over. I bought a lot of stocks during that downturn. In March, I think I bought 30 stocks, but I still had a lot of cash left, and this was one that kind of took a double dip, and I was able to kind of snatch it up in May when things were looking a little bit brighter. I mean, we knew the Fed was coming in. We knew the government was going to help. We knew a little bit more about the virus and everything, so I bought it when it was about 50% off its high. And I wrote about that a couple months later. I bought so many stocks it took me a while to write about it. So I wrote public articles about 20 of those 30 stocks that I bought in March of 2020. And I wrote most of those in like May, June, early July maybe of 2020. So within the next couple months, I finally got them all written. And this was one of them. So in that original article, I explained kind of why I bought it at the price I bought it, what I expected to happen. And then about, what are we looking at, a year and a half later, I took profits in USB, and I wrote an article about that as well. And here's how that did. So I basically got a double in about a year and a half, and it outperformed the S&P 500. And so that was just a win all the way around. And then in this article, in that Taking Profits article, I explained why I was taking profits. And then since then, the stock basically trended down a little bit more than the S&P 500 already. And then with the banking crisis, it traded down a lot. So this is how cyclical investing is supposed to work. It's nice to get kind of like a quintessential example of really this is exactly how you draw it up when you try to execute this strategy. So it was good to have one of those because there's been a lot of weird the pandemic produced a lot of weird patterns that aren't typical. So it was good to have something come through that kind of was typical, except for the speed of the recovery. Normally that's a recovery you expect to take like 3, 4, maybe even 5 years to happen, and it happened a lot quicker in a year and a half. So I wouldn't that was abnormal, but the ultimate total returns and goals and everything were the same. They just happened a lot quicker. So I reviewed that, and I want to go back. Okay, so then I get to the article I wrote last summer where I shared my buy price in that article. I was looking for about a 50% drawdown. Now, I'm not predicting necessarily that it's going to fall that much in a certain period of time. I'm just saying if it does, then I'm prepared to buy, right? So it's the difference between having a buy price and a target price, right? Maybe it falls that far, maybe it doesn't. I show historically that there's a good chance that it will, and if it does, then I would buy, and that was $31.79. The price bottomed recently at about $32.72, so it didn't trigger a buy, but very close. I actually had an order in to buy it if it fell that far, and it didn't. And then after that, I had time to kind of sit back, look at everything, review it, kind of take, once we learned more about what was going on with the banks, to think about it a little bit more. So that's what I did, and afterwards I decided to lower my buy price. But let's go back to the original strategy so I can review it. I'm going to try to go quickly. The first thing I always check with basically every stock is the earnings cyclicality. So I probably have a fast graph here. Yes, I do. If you look at their historical earnings pattern here, you can see that this, let me go ahead and blow it up here. There we go, perfect. So we can see that this earnings drawdown, earnings didn't go totally negative, so they always made money, but they went from $2.61 down to 97 cents. So whenever this is more than 50% drawdown, then I count that as a deep cyclical stock. And for deep cyclical stocks, I don't use earnings to value them because the earnings can fluctuate so much. That's literally the definition. Well, the other part of the cyclicality is they need to recover. So if they just fall down and they stay down here, there's not really like a cycle, it's just a decline, right? So you can also see that by 2012, earnings had fully recovered. So this is the type of stock that's high enough quality to invest, but it is deeply cyclical, so you don't want to use earnings, because if whatever PE, did I write it up here? No, whatever PE was trading at here, if earnings fall like 60%, that PE is going to rise rapidly, and it just gives you the wrong signal. Usually they look the cheapest right about here, right at the peaks, right about there, when they're really the most expensive or the most dangerous. So because this is a deep cyclical stock, and I can't use earnings to help me predict future returns, what I do is I use historical price patterns. I look at drawdowns mostly. So I compare it to HBAN. Actually, this is an example of a stock that didn't recover, right? So I had some questions about this one, and I go back and show, well, one, it went really negative, which is okay, but it never recovered. Earnings never recovered. The price never recovered. This one for me, now somebody could have made a lot of money buying it, but for me, this is too risky, right? I want to see a stock that's going to fully recover back to their earnings highs, back to their price highs, that has a history of doing that. So I wouldn't invest. This is an example of a deep cyclical stock that I wouldn't buy. I wouldn't have the confidence to buy on the way down. Now, here's a chart of the historical price drawdowns. This one goes all the way back to the 70s. So we can see we have kind of these shallow ones, but then more recently, we're looking at 60% drawdown, a more than 75% drawdown. And then this is, I don't know, these aren't daily. I think they might be weekly or monthly on these super long charts. So this doesn't show, but this was actually a 50% drawdown. It was actually a little deeper because I was able to buy it then. So we're really looking at the past 3 recessions. This stock has fallen 50%, and I think I went in and so we got a 62% drawdown on the 1999 one. We got a 76% on the 2008 and 52% on the 2020. So what I did we didn't know what the 2021 was going to be, and I knew that USB was kind of high quality. I didn't really feel like the COVID thing was necessarily a banking crisis, and so I just looked at the history and I said, well, if you bought after a 50% drawdown, you would have done really well, and you definitely had a high probability of hitting. Also, at the time, it was on that double dip, so I didn't think the market bottom was in, but I knew that we weren't completely going off an immediate cliff of like Great Depression by then. So or at least I didn't think that was the highest probability. So buying after it was cut in half seemed reasonable, and that's what I did last time, based on the history of the price drawdowns. Now I have a lot of other tests that go into this other than just picking random drawdowns or whatever. I like to see if the revenues are higher than the last cyclical peak. In this case, they're much higher. And then I think I compare it to Wells Fargo, where we see this. They had this initial bump, but then really revenues they've gone down, right? So that's one that I would avoid, and I have been avoiding. Could the business have a fatal flaw? Well, the way I try to judge against this is I look at the history. I usually want for a deep cyclical, I want 2 recessions worth of data, because recessions tend to vary. Usually we don't have the same problems one recession with the next one that comes right after it. So it helps to have 2 different types of recession data to look at. In this case, there was stuff going all the way back to the 70s, so there's chances that it probably didn't have a fatal flaw that hadn't been exposed before. Now, they will come up. Signature Bank is a good example. So I owned that. It did well during the 2008 financial collapse, but this time they didn't, and they went bankrupt. So it does happen, but if you place 50 bets where you have a good history, 48 of those are going to be, they're not going to be like complete failures. I mean, you might have some underperformers, but most of the time that's a good screen. There's plenty of stocks that don't meet those criteria. And when you go through like hundreds and thousands, I've basically gone through thousands, then you kind of get a better sense of how rare the really good ones are. So there's no question USB is like a good... People leave me comments when I write a bearish article that it's a great business and it's a quality business. Well, yeah, I mean, I wouldn't consider buying it if it wasn't. So that's never or rarely the question, unless I'm trying to specifically point out a problem that people might not be paying attention to. But 90% of the time, I'm just talking about valuations and cycles and things like that. I don't really buy stocks that aren't high quality, or that I don't think are high quality. So that's usually a given with me. Clear disrupted threat, nothing. Is it in a recent super cycle? So I don't have like a special way to like clearly do that, but usually what I do is I put up a log chart of the price, and it will usually show the big cycle. I mean, if you see a big bump in a long-term log chart like this, that is worth noting. The only one here is on the high end. We get this 1997 or 8, right? And then on the low end, probably the Great Financial Crisis shows up. But for the most part, this is like this, and it's pretty much steady. And then more recently, it's actually, you don't have like a swooping peak like this. You actually more have like a leveling off. So I don't see anything like a giant super cycle like we had maybe back in the 90s, like up till 98, I'm gonna say this was. So yeah, it looks good to me. Is management corrupt or incompetent? No problem with management for me. Has the price dropped enough to produce alpha in the past? So this has a couple different... This incorporates like how long it takes the stock to recover given how far you're buying it off its highs. And so usually I run those numbers. Let's see, I did a 50% drawdown here. So if you bought after that sort of drawdown in 99, you would have outperformed the S&P 500 significantly on an annualized basis. 2008, about the same as the market. And then in 2020, we significantly outperformed. What was this? This was through when I published the article, but I had already taken profits at a higher price by then. So this is actually better if a person had taken profits near the peak. This was written last summer, so the price had already fallen quite a bit. So generally, it produces you have a you have a pretty good chance of outperforming the market when you buy this stock when it's down 50%. I mean, it's really that simple. So given all that, what's a reasonable strategy? And then I say, oh, reasonable strategy is to buy when it's 50% off its highs. Okay. So this is my last summer article. So my changes were basically, I point out a steep cyclical. I went over my other things. So we have this drawdown already. And if you look at there, I'm going to go back here. So I actually think that we're in a situation now where interest rates could stay higher. The deposits could leave the banks for a longer period of time, and maybe more of them into like money market funds and treasuries and things like that, which means that banks are probably going to have to raise their interest rates on their loans, be more selective, be tightening credit basically, and at least for a period, that's going to put pressure on kind of a longer term earnings outlook for these banks. Also, we're not in recession yet, so we're still seem to be in the early stages to me, and I think there's extra risk because of all those things. And when I looked at the history, I said, well, if you buy after a 60% drawdown, you still would have gotten in on the 99 drawdown. You still would have gotten in on the 2008 drawdown. If you buy after a 60%, I mean, we're already 43% of the way there. And if you buy after a 60% drawdown and the stock price recovers, that gives you a 150% return. So even if it takes more than 5 years for the stock price to recover its old highs, you can still do very well if you're able to buy cheap enough. There's not really anything special with most banks. They're not growth businesses, really. And so it's really important that you buy them cheap and that you buy the ones that can recover in a reasonable amount of time. I mean, that's really the trick. And in between those times, you're just going to get average returns. So most of the time. There's always a couple outliers, but I mean, that's generally the case. So to me, it seemed perfectly rational to lower my buy price to 60% off the highs, which came out to, where are we at? I'm getting into the current situation that I just explained here. So we're looking at $25.43 per share as the new buy price. And if the stock price reaches back to its old highs, you'd get a 150% return. That's worth buying, suffering any additional drawdown, and waiting several years for whatever's happening now to stabilize and the quality banks to kind of rise again and the market to kind of go through its cycle. It just seems like a more attractive setup to me that still has a decent chance of occurring, especially if we're going into a recession or have higher recession risk. I know we haven't gone into one yet, so I know that part hasn't happened yet. And if we do, it's reasonable to think the stock price should fall a little bit more. So that's a quick review of the strategy and why I changed my buy price on UBS. You can see what the buy price is. I would say I'm almost certainly, as long as I have cash, I'll probably be a buyer there. And thanks for watching. I track probably 50 to 70 deep cycle stocks like this from this particular category. We get a lot of industrials, a lot of semiconductors, which we've bought a couple of those this last year, AMD and Micron, right pretty much at the bottom for those two, the near-term bottom. They could still fall, but and I track those in real time. So if you join the Cyclical Investors Club, it's $30 a month, and I have a spreadsheet that has all the high quality deep cyclical stocks and their buy prices. And so it makes it really easy if you just want to track the ones that I think are the best and consider buying at the prices that I think have a good chance of hitting in a recession or a downturn. And I aim for, with this strategy, I usually aim for like 100 or 150% return within 5 years. So that's kind of the setup, and we have that there. I'll leave a link in the description where you can check that out if you want to. And I will see everybody later.